I was using debt all wrong. Fixing this one mistake changed everything. Two people, same income, same job, same city. At 40, identical net worth, $180,000 each. By 60, one has $340,000 in assets, the other has $2.1 million. The difference had nothing to do with luck, nothing to do with inheritance, nothing to do with making more money. It was one thing, how they thought about debt. I used to think debt was the enemy. I paid off everything as fast as possible. I felt responsible. I felt smart. I was leaving tens of thousands of dollars on the table every single year, and I had no idea. Stay until the end, because I'm going to show you the exact debt strategy that wealthy business owners use to build real assets, the tax secret that cuts your borrowing cost almost in half, and the buy, borrow, die approach that lets you access serious money without ever triggering a tax bill. The mistake that kept me broke: treating all debt the same. Here's what I got wrong for years. I looked at debt and I saw one thing, a number I owed, a number that stressed me out, so I attacked it all the same way. Throw money at it, make it go away. Credit card at 22% interest, pay it down. Business loan at 7%, also pay it down. Mortgage at 3.5%, pay it down faster. That last one, that was the mistake, and it was costing me. Meet Marcus. He's 44, runs a small HVAC company in Texas. 2 years ago, he was doing exactly what I did, throwing every extra dollar at his business loan. Felt great, felt responsible. Then his accountant sat him down and showed him a number that changed everything. That 7.5% business loan, after tax deductions, it was actually costing him 5%. That same money sitting in an S&P index fund, historically returning 10% annually. He was paying down a 5% loan instead of earning 10% on that same dollar every month. For years, wrong belief. Debt always costs what the interest rate says. Right belief. Deductible business debt costs significantly less after taxes. A 7.5% business loan at a 33% tax rate actually costs you closer to 5%. This one mindset shift, this one reframe, is what separates people who slowly pay off debt and people who build real generational wealth. The transformation, from stress paying debt to making debt work for you. Let me show you exactly how Marcus did it. He needed a second service van, $60,000. Old Marcus would have saved up for 2 years, missed the work, and lost the revenue. New Marcus, he borrowed the $60,000 at 7.5%. Here's what happened next. Month 1, new van goes to work, generates $3,200 extra per month. Month 1, his CPA files Section 179. He deducts the full $60,000 purchase price in year 1. Month 1 tax savings alone, $16,000 back from the IRS. Year 1, after expenses, the van nets $26,000 in profit. Year 2, loan is paid off, entirely from revenue the loan created. Year 3, plus pure profit, on an asset he still owns, that he built with someone else's money. The before and after here is wild. Before, Marcus saves for 2 years, misses $76,800 in revenue, buys van with cash. No tax benefit. After, Marcus borrows $60,000, gets $16,000 back from Section 179, van pays for itself by year 2, keeps his cash liquid for the next opportunity. Same person, same van. Completely different financial outcome because of how the debt was structured. By the way, if this is hitting different, smash that like and subscribe. If you're serious about getting your credit right and getting funded, grab Credit Rewrite 800, the 800 Plus system, and get funded for your business. The link is in the description. Everything you need is inside. Good debt versus bad debt. The framework that actually matters. Here's the real conversation nobody has. It's not debt versus no debt, it's good debt versus bad debt. And most people are treating them identically, which means they're either paying off the wrong things fast or keeping the wrong things too long. Good debt looks like this. Interest is tax-deductible business loans, investment loans, mortgages, deployed into an asset that generates more than the after-tax cost of the debt fixed rate. You know exactly what you're paying. Repayment timeline matches how the asset generates revenue. Bad debt looks like this. High-rate consumer debt, credit cards at 20% plus, personal loans for things that don't earn interest is not tax-deductible. You're paying the full rate with no offset, deployed into depreciating stuff, a new TV, a vacation, clothes, variable rate. Your cost can spike when rates rise. Here's the uncomfortable truth. The average American is making minimum payments on 5% deductible debt, trying to be responsible while carrying $6,500 at 20% and only paying the minimum there. That math is completely backwards. The real estate play, building wealth with 20% down. This is where it gets genuinely exciting. Real estate is one of the only legal investments where you can control 100% of an asset with just 20% of the money. Think about what that actually means. You put $60,000 down on a $300,000 property. The market goes up 5%. That's $15,000 in equity. But you only invested $60,000. That's a 25% return on your actual invested capital. Not 5%, 25%. And that's before rental income. That's before mortgage paydown from a tenant's rent check. Wrong belief. I can't get into real estate. I don't have enough to buy a whole property. Right belief. Real estate wealth is built through leverage. 20% down controls 100% of the appreciation. Take it one level further. A duplex where the tenant's rent covers the mortgage? You are building equity every single month using someone else's money. Your cash is just the starting point. After that, the asset services itself. The risk is real. Vacancy, unexpected repairs, bad markets, these are real. This is why cash flow positive properties and stable rental markets are the play, not speculative appreciation bets in overpriced markets with paper-thin rental yields. Action steps. Step 1. Figure out your real after-tax debt cost right now. Take your loan's interest rate and multiply it by 1 minus your effective tax rate. That's what the debt is actually costing you. Most people are surprised. Step 2. Before you borrow a single dollar, calculate the expected return on what you're buying with it. That return must meaningfully exceed your after-tax cost. If it doesn't, don't borrow. If it does, consider seriously. Step 3. Talk to your CPA about Section 179 before you buy any equipment for your business. The ability to deduct the full purchase in year 1 changes the entire math of a buying decision. Step 4. Rank your debt. Make minimum payments on low-rate deductible debt. Attack high-rate consumer debt with everything you have. Do not treat a 3.5% mortgage and a 22% credit card the same. Step 5. Look at your entire debt portfolio through the good debt, bad debt lens. You may be paying off the wrong thing aggressively while bleeding out on the other side. Step 6. If you're a business owner, ask your CPA to model the after-tax, after-depreciation comparison between buying equipment with cash versus financing it. The result often surprises people enough to completely change their decision. I spent years thinking debt was something to fear and eliminate at all costs. And that mindset quietly cost me in missed investments, missed deductions, and missed opportunities that I'll never fully calculate. The shift isn't complicated, but it does require you to stop treating all debt the same way. Good debt, deployed strategically into assets that outperform its after-tax cost, is one of the most powerful wealth-building tools available to regular people. What's your current relationship with business or investment debt? Is it a tool you're using or a problem you're trying to eliminate? Drop it in the comments. I read every one. Subscribe and like and share this with any business owner who's been treating their 5% deductible business loan the same as their 22% credit card. It's costing them more than they know. For more, check the description below.